Friends, thank you for being here today. Have you ever wondered why so many people are investing in the stock market, yet so few of them ever seem to get ahead? Why do you hear stories of people making thousands or even millions, while at the same time, millions of others quietly lose their savings without ever understanding what really happened? What if I told you this massive disconnect isn't an accident, but a carefully designed feature of the modern financial system? And what if the dumb money the experts joke about on television is actually just you, the ordinary person trying to save for retirement? The truth is, something deeply wrong is happening in the markets right now. Most people can feel it, an undercurrent of anxiety beneath the headlines, even if they can't quite explain it. Prices are moving faster, headlines are getting louder, and everyone from financial gurus to amateur influencers keeps saying this is the best time to invest. But under the surface, a silent crisis is forming. It is one that is already bankrupting ordinary Americans, and it is about to get worse. For years, we have been told a simple story that the stock market always goes up. We were taught that it is the smartest, most reliable way to grow our wealth, to beat the corrosive effects of inflation, and to prepare for a secure future. We were told to save, to be patient, to buy and hold. But what if that story isn't true anymore? What if the very mechanism that was once meant to help people build generational wealth, the engine of the American dream, has turned into something that systematically drains it instead? This is not a temporary downturn or a simple correction. It is a fundamental shift in the nature of the market itself. The first and most critical warning sign is that the stock market today no longer reflects reality. It has become untethered from the real economy, the one where people work, produce, and sell actual goods and services. It is no longer about real profits, tangible assets, or groundbreaking innovation. Instead, it is about manipulation and emotion. This disconnect is the foundation of the modern crisis, a crisis that operates in plain sight, disguised as opportunity. It's a crisis that has convinced millions of people that they are investing when in reality they are being led to gamble. The system has become a trap, and by the time most people realize it, it will be far too late. The first and perhaps most blatant warning sign of this silent crisis is the pervasive illusion of a booming, healthy market. What most people see when they look at their phones or turn on the financial news is an endless stream of green arrows and record highs. They see companies like Tesla, Apple, and Nvidia with stock prices that have soared, sometimes doubling or tripling in mere months. The logical assumption is that these companies must be making that much more money, that their profits have exploded, or that they have unveiled world changing innovations to justify such valuations. But this assumption is in large part wrong. What is truly driving these prices is not fundamentals, but pure, uncut momentum. Investors are no longer investing, they are chasing. Everyone wants to get rich fast. And more importantly, nobody wants to miss out. This fear of missing out, or FOMO, has become the market's primary fuel. It is a powerful psychological accelerant that pushes prices to levels that have no basis in reality. But when everyone in the market believes that prices will only go up, that is the exact historical moment when they are primed to fall. This pattern repeats itself with terrifying regularity throughout history. It happened during the dot-com bubble in the late 1990s and early 2000, when companies with no profits and no viable business plans were valued in the billions only to vanish into thin air. It happened again more recently in 2021. Millions of new, inexperienced traders jumped into the market armed with commission free trading apps like Robinhood. They bought anything they could from meme stocks to speculative cryptocurrencies, believing they were financial geniuses. They believed they were investing when in reality they were gambling. What gave them this false confidence? A perfect storm of factors. Stimulus checks from the government gave them free money to play with, and social media platforms gave them the confidence and the community to justify their riskiest bets. But now those same people are sitting on devastating losses they don't talk about anymore. The social media posts have gone silent, and the diamond hands have turned to dust. Compounding this illusion is the deception of the market indexes. People are told to look at the S&P 500 as the ultimate benchmark of market health. Today, that index might be hovering near record highs, leading the average person to believe that the economy is strong and their investments are safe. But here is the uncomfortable truth. Only a few massive companies are actually holding that index up. If you were to take away a handful of giants, Apple, Microsoft, Nvidia, and Amazon, the rest of the market, the other 490 plus companies would look flat or even negative. Most people do not realize this. They think the entire market is booming, that a rising tide is lifting all boats. But what they are really looking at is an illusion, a Potemkin village built on a handful of mega corporations. This is how the first trap forms. People think they are diversifying, that they are growing their wealth by buying the market. In reality, their financial futures are being chained to an increasingly fragile and narrow system, pulling them deeper into a trap just before it snaps shut. The second warning sign is even darker, and it is one that history always punishes with the utmost severity. Americans are borrowing record amounts of money to invest. This isn't just institutional borrowing, this is a sickness that has infected the retail investor. Margin debt, which is the money people borrow directly from their brokers to buy more stocks, has exploded to levels we have only seen immediately before major devastating market crashes. The psychology behind this is simple and seductive. When everything looks safe, when stocks seem to only go up and profits are rising, people get greedy. They want to amplify their gains. Borrowing money to buy more stocks feels like a genius move, but when prices drop even slightly, those same loans, which felt like an opportunity, turn into ticking time bombs. This is because when you invest with borrowed money, the smallest loss can wipe you out completely. We all saw this happen in real time during the tech stock collapse in 2022. People who thought they were buying the dip with borrowed cash were suddenly faced with margin calls. A margin call is a demand from your broker to add more money to your account to cover your losses. If you cannot produce the cash, the broker forcibly sells your stocks at the worst possible moment at the bottom of the market to cover your loan. And once you start selling to cover your losses, the market doesn't just fall, it unravels. It is a cycle that feeds on itself. Panic selling leads to lower prices. Lower prices trigger more margin calls and more panic. Before long, billions and then trillions of dollars vanish in a matter of days. What makes this bubble so uniquely dangerous is that it is not just margin debt anymore. The craziest part is that Americans are now using credit cards, personal loans, and even tapping into their home equity to gamble on the stock market. They are desperate. This is not the calculated risk of a seasoned investor. This is the last ditch effort of a population pushed to the brink. This brings us to the root cause of this debt bubble. It is not about greed anymore. It is about fear and survival. Inflation has silently eaten their savings for years. Wages have not kept up with the soaring cost of housing, healthcare, and education. People feel like they are drowning, and they have come to believe that investing, or rather gambling, in stocks is their only way out. This is not investing, it is survival disguised as opportunity. And survival makes people take risks they do not understand, risks they would never take if they had other safer options. That is why this debt bubble is so incredibly dangerous. It is not fueled by optimism, it is fueled by the fear of being left behind. People are terrified of a future where they can never retire, where they are always one medical bill away from bankruptcy. And fear is the most powerful and volatile fuel a market bubble can possibly have. When this bubble bursts, it will not just deflate, it will explode, taking with it the hopes of an entire generation. Then comes the third and perhaps most insidious warning sign: the illusion of safety. For decades, the financial industry has peddled one simple piece of advice to the average American: just keep buying. They tell you not to worry about corrections, to ignore the volatility, and that if you just invest for the long term, you will always win. This advice, that time in the market beats timing the market, is true, but with a massive, devastating caveat. It is only true if you can afford to wait 20 or 30 years. Most Americans do not have that kind of time. When you are close to retirement, when you are relying on that money to live, a single crash can erase an entire decade of savings. Think about that for a moment. Imagine a couple who did everything right. They saved diligently for 40 years. They amassed $400,000 in their retirement accounts. Then, during the 2022 downturn, they watched it fall to $300,000. In a vacuum, the buy and hold advice would tell them to just wait, that it will come back. But they do not live in a vacuum, they live in the real world. At the exact same time, their account fell by $100,000. Inflation went up. Groceries became more expensive. Their utility bills rose. Their rent increased. Suddenly, their long term investment was not enough to cover their short term reality. They were forced to withdraw more money than they had planned, selling their assets at a loss just to survive. Even when the market later recovered, it did not matter. They had already been forced to sell too much at the bottom. Their wealth was permanently depleted. That is how people lose their wealth quietly. It is not always in a dramatic single day crash. It is in the slow bleed that happens while they are being told to just stay invested and ride it out. And it is not just stocks. For decades, retirees were told that bonds are the safe asset, the ballast in a portfolio. They were told that bonds protect you when stocks fall. But in 2023 and 2024, bonds collapsed too. Interest rate changes wiped out people who thought they were diversified, who thought they were protected. The balanced portfolio, the trusted 60-40 split that everyone from financial advisors to retirement funds relied on, turned into a trap. This is what makes the current market so cruel and deceptive. It is not breaking the rules, it is rewriting them. These people did everything right. They saved their money, they diversified their assets, they followed all the rules they were taught, and they still lost. The game they were told they were playing is no longer the game that is being played. This leads to the fourth warning sign, something that most people do not see at all because it happens in the shadows behind the curtain of the daily market noise. It is the silent, ongoing transfer of wealth from Main Street to Wall Street. Every single time retail investors, the ordinary people, panic and sell, institutions are on the other side of that trade, quietly buying everything they are giving away. Hedge funds, private equity firms, massive banks, and even central banks use volatility to their advantage. They want fear, because when fear rises, prices fall. And that is when the rich load up. They buy perfectly good assets for pennies on the dollar from people who are forced to sell either because of margin calls or because they simply cannot stomach the fear. Then, when the panic subsides and optimism slowly returns, these same institutions sell those assets back to the very same people who panicked before, but at a much higher price. It is not a conspiracy, it is a system. It is a system built on psychology, on the predictable emotional nature of the human mind. It is a system designed to transfer wealth from the impatient to the patient, from the emotional to the disciplined, and ultimately from the poor to the rich. Consider this staggering, uncomfortable fact. The top 10% of Americans own more than 90% of all stock market wealth. 90%. So when you hear on the news that the market is doing great or that household wealth is at an all time high, you must ask yourself, who is it really doing great for? Because it is not for the millions who are cashing out their retirement accounts early just to pay their bills. It is not for the families watching their savings melt away from inflation. It is for the few who understand how to make money both when the market rises and, even more importantly, when it falls. The market has become a grand illusion, a spectacle to keep the masses hopeful, while the real wealth is siphoned off by the few who control the system itself. But this transfer of wealth is no longer just a game of psychology and patience. In the 21st century, it has become a game of speed, a game played by machines, not humans. This leads to another critical warning sign, one that operates almost invisibly: the complete automation and algorithmic takeover of the market. The system that the average person tries to invest in is no longer a market of human buyers and sellers weighing the future of a company. It is a digital arena where competing algorithms execute millions of trades in the blink of an eye. This is the world of high frequency trading, HFT. These are sophisticated programs that buy and sell stocks in microseconds, faster than a human nerve impulse can reach the brain. They do not read quarterly reports. They do not analyze management teams. They do not care if a company makes a quality product. Instead, they are designed to do one thing: exploit microscopic, fleeting inefficiencies in the market structure. They trade on momentum, on statistical correlations, and on the ability to simply be faster than everyone else. This algorithmic dominance creates a dangerous illusion of liquidity. The market may show billions of shares trading hands, making it look robust and healthy. But in reality, a vast portion of this is just algorithms trading back and forth with other algorithms, creating a phantom liquidity that can and does vanish in an instant. We have seen this before in flash crashes moments where the market inexplicably collapses by trillions of dollars in minutes, only to rebound just as quickly, leaving human investors baffled and terrified. This occurs because the algorithms, all programmed with similar risk models, detect the same sell signal simultaneously and rush for the exit at once. The buyers simply disappear. For the ordinary investor, this automation is a tax on every single transaction. The institutions that own these algorithms, the very same top 10% discussed earlier, use this speed to front run retail orders. When you decide to buy a stock on your app, your order is sent to an exchange. In the milliseconds it takes for that order to be processed, an HFT algorithm sees your intention, buys that same stock milliseconds before your order can be filled, and then sells it back to you at a slightly higher price. It is a profit of perhaps a fraction of a cent per share, but multiplied by billions of transactions, it amounts to a systematic siphoning of wealth from the public. It is a high-tech version of the quiet bleed that drains retirement accounts, only it happens to everyone every single. This is why the market feels so disconnected from reality. It is why prices can swing wildly on no news, or why a good earnings report can be met with a massive sell-off. Humans are no longer in control. The market is being driven by code that is optimized for speed and volatility, not for long-term value or economic stability. This automated predatory system is the engine of the trap. It ensures that by the time you see an opportunity, it is already gone, and by the time you sense danger, you are already the last one out the door. And that brings us to the fifth and final warning sign. the one that could trigger everything else, the coming correction. You can already feel it in the air, like the stillness before a violent storm. The signs of deep economic strain are everywhere if you are willing to look past the record high headlines. Corporate earnings are slowing down. Companies are laying off workers again, not to innovate, but to cut costs. Credit card debt has surged to an all time high, meaning the average American is living on borrowed money. And, most tellingly, personal savings rates have hit their lowest point in over a decade. People are not saving, they are surviving. These are not signs of strength, they are signs of profound strain. The entire economy is leaning on one thing: hope. Hope that interest rates will be cut. Hope that inflation will magically disappear. Hope that the market will somehow, against all logic and history, keep climbing forever. But hope is not an economic strategy, and history has shown time and time again that when optimism becomes blind, a collapse inevitably follows. Right now, many companies floating on the market are what analysts call zombie corporations. They are technically alive, but only because they can still borrow money at artificially low rates to pay the interest on their old debts. They do not generate real profit. They just survive by taking on more debt. If interest rates stay high, or even if they just do not go down as fast as hoped, those companies will die. And when they do, they will not go quietly. They will drag entire sectors of the economy down with them. It is the exact same setup we saw before the 2008 financial crisis, before the dot-com crash in 2000, before every major market breakdown in history. The fundamentals are ignored, leverage is high, and the entire system is balanced on a pinpoint of blind faith. The collapse itself will start quietly. Prices will dip a little. The financial news will call it profit taking or a healthy correction. People will say it's just a temporary blip. Then suddenly something will snap. A big company will miss its earnings forecast disastrously. A major investment fund will blow up. A bank will fail. Panic will spread like a contagion. Algorithms, which control the vast majority of trading, will kick in, amplifying the sell orders. And before you can even blink, billions of dollars will vanish. The sell orders will pile up faster than the system can possibly handle. That is when fear turns into pure, unadulterated chaos. The truth is, the stock market is not crashing yet, but it is preparing to. It is meticulously building the perfect storm. You can already see it in the extreme volatility, the rapid gut-wrenching swings, the strange nonsensical rallies that are erased the very next day. This is what happens before every major correction: confusion. Because confusion is a tool. Confusion keeps people in. Nobody wants to sell if they think another rally is just around the corner. That is exactly how the system works. It traps you with greed, then it crushes you with fear. And when that fear finally takes over, it will not just take profits, it will take futures, retirement accounts, pensions, exchange traded funds, ETFs. They will all move together. In a real crash, diversification does not save you, not when everything is tied to the same fragile algorithms and the same panic psychology. In the end, the crash does not destroy money. It merely transfers it. It transfers it from the many to the few. It transfers it from those who trusted the market to those who control it. That is how the game has always worked. The market does not care about your retirement, your family, or your future. It does not care about fairness. It only cares about liquidity, about who can buy when everyone else is forced to sell. So what can you do? How do you protect yourself from a system designed to fail you? First, you must stop thinking the market is your friend. It is not. It is a cold, indifferent mechanism that rewards patience and relentlessly punishes emotion. If you invest your hard earned money without understanding the risks, without understanding the game, you are not investing. You are gambling. and the house always wins. Protect your cash. Diversify outside of the hype. Do not chase what has already gone up. Be skeptical. Be patient. Because when everyone thinks it is safe, that is precisely when it is most dangerous. When the headlines all say the worst is over, that is usually when the worst is just beginning. The hardest part about what's coming is not the crash itself, it is the illusion before it. It is the manufactured calm, the blissful optimism before the storm. Right now, most people are still optimistic. They think the market has already survived the worst of the inflation, the worst of the rate hikes. But markets do not go up forever. Every boom in history has had its breaking point, and every record high is eventually followed by a painful reckoning. You can ignore the signs for a while. You can pretend that this time is different, but it never is. The higher the market climbs on a foundation of debt and hope, the harder and more devastating its inevitable fall will be. And when that fall begins, it will catch almost everyone off guard. The next stock market crash will not just take money, it will take trust. It will take years of savings, decades of hard work, and it will leave people wondering how it all happened so fast. But if you look closely, if you are willing to see past the illusion, the signs are already here. You just have to be willing to see them. Because the truth is, the stock market is not broken. It is working exactly as it was designed to do, to make a few people richer by bankrupting everyone else. And if history is any guide, the next phase of this story will not just be painful, it will